Thanks so much, Elizabeth. I would just add two little notes. One, mark your calendars for our conference. It's going to be Tuesday, October 14th. Um, so make sure that you mark that down, and you and all of your colleagues are invited. And two, since we're recording this, feel free to turn off your cameras if you don't want to be, captured on the recording while Julie's talking. We certainly understand. Having said that, let me introduce Julie Hamry. Julie has over 40 years experience in nonprofit accounting, serving churches, volunteer programs, performing art groups, after school and daycare programs, rowing clubs, senior villages like us, and a program that supports career aspirations for college students from underserved populations. She has extensive experience with QuickBooks and Excel and has worked with several donor databases. She also herself has served on several nonprofit boards, including N Street Village here in DC and Muhlenberg College in Allentown, Pennsylvania. That service has been invaluable in helping her understand the relationship between staff and board from both perspectives. Julie was at our conference last year in October, and she's going to be at our conference again at the 25 conference. Why is that? Because Julie's also the Wave bookkeeper. Yay and thank you. She has made my life as treasurer a pleasure, and I couldn't imagine doing it without her. So having said all that, let me turn it over to Julie.
Oh my gracious, that's way too kind, Wendy. Thank you. Yes, it is true. I have 40 years of experience. You can tell by the color of my hair. I would like to tell you it's because I started when I was 12, but that is unfortunately not the case. So I have been around nonprofit accounting for a long time. And although I do not have a CPA, I have been through, oh Lordy, at least 100 audits. So everything I know, I've learned from auditors who certainly do have CPAs. So I don't think I will give you any bad information this morning. This is a 101 class. I apologize for those of you who have been doing this for a while, because some of this is going to be pretty basic, but I was asked to sort of start from the beginning and do an outline that would be helpful to folks that don't have a lot of experience in trying to set up accounting for their organizations. What I'd like to do is to start by talking about the basic documents or pieces that you need to have a good accounting system. And the first thing that you need is a good list of accounts, or a chart of accounts, as it's called. The chart of accounts is your basic building block to have a system that is useful to you and gives you the information that you need to know. When you set this up, there are some basic guidelines that will make it easier for you to use the information that you enter into your system for grant reports and other kinds of reporting. And there are some, I don't want to say there are some standard accounts that I recommend that everybody use. You can do it any way you want, but I recommend that you use these. For example, there are some accounts in your income section and your expense section that apply to everybody. And the more unified we can all be, the better it will be for trying to exchange information or to see how you're doing compared to other people. Generally speaking, it's better to have fewer accounts than many, because too many can be confusing, and too many can lead to inconsistent classifying of expenses. And you want to be consistent about the way that you classify your expenses, again, so that you can work with your budget more effectively and do comparisons across years more effectively. I'm sharing my screen to show you this chart of account listing that I have here. These at the top are basically your assets, what cash you have and what furniture and equipment you have, if any. That's in the 1000 series. In the 2000 series, there is these are your liabilities, things that you owe to other people. And in the 3000 series, this is your assets minus your liabilities, and that ends up with what's called net assets. I believe that this document is going to be put into the chat Is that right, Kim? So that folks can download it directly?
Yes.
Yes, okay. So so you don't have to try and scribble all this down as we go through this. The next section is your income. This is the type of income you receive, and this is pretty straightforward and should be quite similar across all of the villages that you work with. You have direct public support in terms of contributions, both individual and from businesses. You have your revenue from grants, foundations, community organizations. You have government grants. We're not getting any more COVID grants, but we did for a while. You have program income, which is your membership dues primarily, and also if you charge for events, classes, and fees. You have your fundraising income, especially, this is really, I should clarify this, this is really event fundraising income. So if you have any kind of a dinner or some sort of a program where you charge money and part of the ticket is for cost of the part of the ticket covers the cost of the event and the other part is a donation. And then you have miscellaneous income. My favorite example here is the cashback rewards that you get from from your credit card. Then you have your various expense categories. And again, these are the ones that are going to vary in many respects from each of you based on what you are doing and what your activities are. But as a bottom line, you probably will have some where you record your expenses for member activities. If you have paid employees, you would have personnel costs. If you do not have any paid employees, you would have this category called outside contract services, which is where you would put all of these various kinds of things, including your audit and accounting fees, your grant writer, so forth and so on, if you have any of these things. Many of you probably have none of these things, but this is where you would put them. And then you would have a category for operating expenses, pretty self-explanatory there. And again, you would have a development account, expense account, where you would record your expenses for the event. Up here in income, you had your development income. Down here, you have your development expenses. I'll stop here and ask if there are any questions at this stage.
No, not yet.
Okay, so the reason I start with this is really, this is your basic building block, and you can update this as you go from year to year, but this really should reflect what your organization does. And I think that's important that you show that. The next thing I'm going to talk about is building a budget. Now, budgets, everybody loves budgets and hates budgets. Budgets are your best guess estimate of what's going to happen in the upcoming fiscal year. They really do need to reflect your organization's plans for the future. But it is also very important that you remember that budgets are aspirational. I work with one organization that has a fiscal year that is basically a calendar year, but they have to pass the budget at their annual assembly, which is in May of the prior year. So in January and February of fiscal year, the current fiscal year, I'm trying to put together a budget that's 12 months off. That's hard. Hopefully most of you are putting together budgets based on a time frame that is closer to whatever the beginning of your fiscal year is. So the way you start building a budget is you start with what you've spent during the current year and ideally what you've spent during the prior year. And that's obviously your starting point on how you build a budget. Then you look at it and you say, okay, what is it that my organization wants to do in the new year? For example, we want to have more events and classes. So you would build into your budget some income, perhaps, if you charge for that, for events and classes, and you would build into your budget your expenses. Usually the expenses are easier to do because you know what you've done in the past and they're easier to predict. What is clearly difficult is to predict your income. I have no answer. I wish I could tell you the magic formula to use to predict your income. Again, with your dues, you know what you had in the past. You can assume that you will keep the same or maybe increase it a little bit. But the real bugger is grant income and contributed income, and you don't know what you're going to get. So you do make an educated guess. And again, I will say, remember that budgets are aspirational. And depending on how your own board of directors work, they may or may not be modified throughout the year. Now, I do not recommend that you change your budget every month. But it is certainly reasonable to have a budget. Let's presume you're on a calendar year basis. You have a budget that you pass in November or December for the upcoming calendar year. You start the calendar year at the end of the first quarter. You compare it to where your budget, where you compare your first quarter to your budget and see how you're doing. It's not going to work out to be that you brought in 25% of your income and you spent 25% of your expenses, but it will give you an idea of what's going on. As I said, some organizations choose to do a revised budget in the middle of the year. So if, for example, you do not get the big grant that you were hoping for, you can revise your budget in the middle of the year to show your board how you're going to account for that. On the other hand, if you do get a big grant that is unexpected, you can revise your budget to show what you're going to spend the money on. So again, while I wouldn't revise it every 2 or 3 months, a mid-year correction on your budget is fully appropriate and probably very helpful.
Julie, it's Wendy. I'm just going to affirm something you said, which is budgets are aspirational. You know, I learned that from a prior employer, that, you know, we always will build a budget saying, well, this is how much money we have. And he would go, well, we're trying for these grants and, you know, 50% likelihood of that, 70% likelihood of this. And he really talked about including those aspirational pieces of income in your budget. And at the same time, keeping an eye on your expenses as the year goes along. But don't be afraid to include the aspirational expenses. And I just wanted to affirm that from our point of view here in my village.
Yeah, no, I think that's exactly right. The other thing I will tell you that drives me crazy is so many staff that I work with, you know, we give them a budget at the beginning of the year, and then a third of the way through the year, we're not bringing in, you know, as much money as we had hoped. So we're thinking about how we're going to cut expenses. And the staff goes, but it's in the budget. But that money was in the budget. There is no money in the budget. There is only a projection of how much money you might get. And I think dealing with your staff, this is one of frankly, the most challenging things that I've had is yes, we said that you would have $5,000 to work on this summer program, but it's now May and we raised $2,400 of it. You don't have $5,000. So that's something that I just warn you, you will probably have to deal with regard to, working with your staff and knowing what your budget is. When I did this seminar last year, we got a couple of questions about some specific things. And so I'd like to talk a bit about that now. One of them is in-kind donations. And how do you reflect or record in-kind donations to your organization? And there are several types of in-kind donations. One of them is if somebody gives you services. Now, services are divided into 2 types. The first type is the service that you would have to pay for if somebody didn't donate it. For example, accounting. If somebody says to you, I have experience in accounting, or I'm a CPA and I'm willing to do this for free, that is an in-kind donation. And you would record that up in your income categories as an in-kind donation of $2,000, which would be offset by an in-kind expense, accounting expense of $2,000. So you do include in-kind services if they are the services that if they weren't donated, you would have to pay for them. There are no, the accounting one is the best example. Graphic design is another one, so forth. What you do not include in your accounting is in-kind volunteer services, and all of you have tons of this. We're, people that actually sort of do the day-to-day work of taking folks to the grocery store, to doctor's offices, or whatever. It is appropriate and good and advisable that you track those as much as you can, because you'll need that information in order to tell your story to the world, to put into grant applications and so forth, that you've got, 200 volunteers and they gave X number of hours of volunteer services last year. But you do not include those in your accounting records. The in-kind services that you do include, the ones that you would have to purchase if you weren't donated, have no net effect on your financials, because they're in-kind donation, in-kind income set off by an in-kind expense. The other in-kind donation, or the other thing that is often confusing to folks, is in-kind donation of property. Somebody gives you a computer. How do you record that? Theoretically, you record it in your books at the fair market value of what the computer is worth. How do you know that? I don't know. If the computer is 3 years old, chances are the fair market value is 0, so you don't even have to worry about it. If somebody gives you a brand new computer, the value of that is recorded as an in-kind donation of, say, $1,000, and it is not an expense to you, but in that case, it is a piece of equipment, and it goes on your balance sheet, which we'll talk about in a minute there.
And Julie, related to that, there was a question, would you recommend recording below market facility rent as an in-kind donation?
Yes, I would. Absolutely, I would. But again, it would be an income offset by an expense. But absolutely, I would do that. So you're, in that case, if it's below market, I assume if you're paying, $100 a month, but in fact, it would be $500 a month, then you have a true expense, if I can use that phrase, of $100 and an in-kind donation and an in-kind expense of $400 a month. So yes, I would definitely do that. Okay. Are there any questions, comments?
Okay.
This report that I'm showing you here, which is the budget versus actual report, is what's called a statement of activity, or in normal accounting speak, a profit and loss statement. One of the things that drives me crazy about real accountants is that they have different terminology for nonprofit and profit-making accounting that is for exactly the same document, exactly the same kind of a report. So this is a statement of activity compared to budget. If I were a dry cleaner, this would be a profit and loss compared to budget. So just understand that a profit and loss is exactly the same thing as a statement of activity. I have seen more grantors than I care to think, people that are in the business of nonprofit accounting, that continue to ask for profit and loss statements. We all know that nonprofits don't make profit. They make excess income, but that's what it is. So I just want to warn you that statement of activity and profit and loss is exactly the same thing. And as you can see here, this is a report that you can easily pull out of QuickBooks automatically once you've entered your budget information into the system. Shows what January to May is. This is a calendar year organization. January to May actual activity, the full year budget, and then the variance both in dollars and in percent of the budget. So in this case, you can see that they're doing, you know, great in terms of percent for corporate contributions, but of course they didn't have a very large budget for that to begin with. So the percent can be a little deceiving, I think, but the dollars over or under budget is really where you ought to be looking. And you ought to be looking at this every month and seeing, you know, you need to be able to explain to yourself, excuse me, if not to your board, why the variances are what they are. Some of the variance will be, you know perfectly well that's what it's going to be because you don't get your grant from, you know, the Smith Foundation. You know that that always comes in October, and so you know that that's not going to be here now. But a review of this and knowing for yourself why things are different is really important and helpful. And obviously, that's exactly the kind of question that your board is going to ask. So in this case, we have, you know, they're $173,000 behind their budget for the year, but I could go through if I wanted to and tell you, you know, all of these things like here for their event donation, they haven't had their event yet. So obviously they don't have that money. Expenses are the same way. Some of the expenses are very predictable in terms of salaries, for example, you know, that are spread, you know, they're 42% of their salary expense has been used up, but they're, you know, April to January through May is not quite half. So they're right on budget with their salaries. This is a report that I just use, you know, all the time. And when I'm trying to write up notes for various folks about, you know, what is it? This is where I'm on the phone with the executive director to say, remind me why class instructors are only at 33%. Why is it not more? And the executive director will say, well, that's because we do so many of our classes in the summer. Oh, okay. Well, that makes sense. And that's why we're going to do this. That's why it's behind. At the bottom of all of this, you get to this magic phrase of net income. This is, as you might expect, your total income of $135,000 minus your expenses of $129,000, and this is what your net income is. There will be months during the year when this is a big negative number. And again, you don't necessarily need to panic over that unless you didn't expect it. I will also say that you can do your budget month by month. You can basically take your annual budget and split it out month by month. That takes some work, but it can be very useful. Don't just divide by 12 unless it's something like salaries, which you know will in fact be spent on a equal basis across the year. But actually think about when the money is going to come in and when the money is go out. If you do that, then you can again run reports. I'm always referencing QuickBooks because so many of you use that. You can run a QuickBooks report that shows what your January to May actual is and what your January to May budget is, not your full year budget, but your January to May, or, you know, month by month to see where things are going. I actually advise you to think about doing the monthly budgets, but it is certainly extra work, depending on the size of your organization and how much detail your board wants. You know, it's totally up to you as to, you know, whether you do that, but it is something that can be helpful.
Let's see, Wendy put a question in the chat. Wendy, go ahead and read this.
Yeah, Julie, when I look at the expense categories where it says things like decorations, flowers, you know, tips and gratuities, are those preset in QuickBooks? Or are those categories that you establish a name?
Good question. No. QuickBooks, if you buy the nonprofit edition of QuickBooks, it will come with a proposed chart of accounts, which you can ignore completely. Or more likely, what you can do is rearrange it a bit and make it work for what you have. This is a pretty active village that does, where the executive director wants to see all of these broken out expenses. Frankly, you don't need to have this many columns. You don't need to have, you know, an auction expense line when you know you're only going to have one item in there at the end of the year. It's up to you as to how much detail you want. Generally speaking, for smaller organizations, I suggest that you have fewer rather than more details. As I mentioned earlier, one of the reasons for that is that it's easier to be sure that you're being consistent in the way that you're classifying your expenses. I'm going to scoot down here to the very bottom. This is a another report that you can get out of QuickBooks that will show you exactly what's in each item. So for example, here in class instructors, you can see that we have, you know, you can see what's in there. Who are these people and how much are they getting paid and that sort of thing. For the database for Helpful Village, this is the monthly expenses for Helpful Village, et cetera, et cetera. This report, you do not want to give to your board. Repeat, you do not want to give to your board. The reason you don't want to give this to your board is that you don't want your board going, but wait a minute, what's that $25 to Voce Italian Deli? Really, that's not their business. They need to be thinking about bigger things. But this report is invaluable when you go to do your budget. And you can see exactly what it was that you spent in each of those categories and when it was spent. It's really a very, very helpful report. And I urge you to put, basically to put as much detail as you can in there, including this description in what in QuickBooks is called the memo field. You know, what are these things? What did you use it for? Here's the insurance category, for example. These are the specific insurance policies that were done. So it's very helpful in that regard. But the QuickBooks one is pretty long. It's got a lot of categories in it, and it's fine. There's nothing wrong with it, but you should have one that is, number one, labeled the way that you think of things in terms of what they call stuff. And number two is set up in a way that, again, will support your organization, you know, in the best possible way. So this number here, the $6,400 number, is your net income year to date. This is money that is excess for the year to date. You brought in X number of dollars, you spent Y number of dollars, and how nice there is a surplus year to date. The profit and loss statement or statement of activities shows activity in your account over time. In this case, it shows the activity from January through May. So it's that 5-month period over time. That's important. The balance sheet, or in nonprofit parlance, the statement of financial position. Again, isn't that silly? Why can't they just call it a balance sheet? But they don't. This shows the organization's fiscal health as of a single point in time. And that's very important to understand the difference. This is what the organization has in terms of its financial assets and so forth as of May 31st. So it's got these 4 bank accounts. As of May 31st, the balance in their checking account was $42,000. As of June 1st, the balance in their checking account could be $22,000 if they spent the money. So remember that this is a single point in time, and it is important, and I'll talk about that in a little bit, but it's not over time. This shows where you've been going over a period of time. This is where you are as of May 31st. The balance sheet is arranged to show your assets, which is what are the things that you have that you own. In most cases, your organization will have bank accounts, and perhaps an investment account, which actually this one didn't have, but nonetheless could. If you actually are fortunate enough to have reserves that you have invested. I'd like to take a brief sideway here and talk a little bit about the difference between cash accounting and accrual accounting. Most of you probably, oh, I shouldn't say that, I don't know. Many of you will use cash accounting, and cash accounting is very straightforward and it's the easiest way to maintain your books. And what that means is basically it's like your checking account. Your checking account records income when the money goes into the bank, and it records expenses when you write the checks or pay the credit card bill. And what you have in the checking account, therefore, is, you know, what your asset is. That's fine. And for many organizations, particularly smaller ones, that's all that you need. However, it is not necessarily going to give you a full picture of where your organization stands. And to do that, you use accrual accounting. And let me explain a couple of those things. One of the things on accrual accounting is your receivable. So let us say, for example, that somebody says, I'm the so-and-so foundation, and I'm going to give you $5,000 in June. So you are, under accrual accounting, you record that $5,000 as a receivable. You haven't got it yet, but it's going to come. And so you can record it on your balance sheet as a receivable and as income to your organization. The reason that you want to do that, and on the other side of it is your payables. In this case, there were none, but your payables would be, okay, I have a bill sitting in my inbox for, you know, the audit for $6,000. I haven't paid it yet, but the bill came in. And if you record that under accrual accounting, you record it as, excuse me 1 second, I'm sorry.
I'm just going to pop in here and say one thing, which is that there were some questions in the chat about people who use QuickBooks, wanting to know if people have what edition people are using and what they're paying. So that isn't a question exactly for Julie, but if other people want to weigh in on the chat, that would be helpful.
Actually, it is a question for Julie.
Oh, great.
Wrong about this.
Okay, great. That would be great if you want to talk on that. And then somebody also asked if you have any experience with Zephy, which is free fundraising software.
Okay, for the QuickBooks thing, I will just say very briefly, the best, in my opinion, QuickBooks desktop version is by far the best version of QuickBooks. It used to be that QuickBooks had 3 different levels, Pro, Premier, and Enterprise. For the desktop version, Pro and Premier were significantly less expensive than Enterprise. It was fine. QuickBooks is forcing everyone to change. No longer can you buy QuickBooks Pro or QuickBooks Premier, or even if you could, they're not going to support them anymore. The only versions you can get of QuickBooks are now either the Enterprise version, which is by far the most expensive and has a lot of bells and whistles that most small organizations don't need, but it is the desktop version. And it will have an annual license fee, probably of over $1,000. I wouldn't be surprised if it's as much as $1,500 a year. QuickBooks Online should be a great product. I find it very cumbersome, very difficult to use. It takes 3 or 4 clicks to do what you can do in 1 click on QuickBooks Desktop, et cetera, et cetera. But it is cheaper. It has 2 major advantages. One is that since it's online, since it's in the cloud, you can have your multiple users who can access it, as with everything on the cloud, from anywhere. So if you do have the luxury of a separate bookkeeper from a bookkeeper plus an account, a treasurer, then your treasurer and your bookkeeper can both access it, and that can have real advantages to you. The second advantage is if you can purchase it through TechSoup. For those of you who haven't heard of it, TechSoup is a terrific site that offers discounted software to nonprofit organizations. If you can purchase it through TechSoup, you can get it for, I think, as little as like $80 or $90 a year, which is a significant savings. I totally get that. So I won't say go into it and grade I won't say much more than that, but I will say that you will not be, the only desktop version you will be able to buy in the future is the enterprise version, which is expensive. So whether we like it or not, we're all going to be moving to the cloud in that regard. And what was the other one?
Do you know about Zephy, which is free fundraising software?
I have not heard of that one. Sorry.
Yes. So if any other people on the call today want to go ahead and go in the chat with their recommendations too, that's really helpful for us to share.
Okay, so if we can scoot back to accrual accounting again. So accrual accounting lets you record income that you know, repeat, know, not guess, know you're going to receive. And also it lets you record expenses that you have sitting in your inbox, but that you actually haven't paid yet. Primary example would be your credit card. What this does is allow you to, it allows you to put your activity in the right period. And during the course of the year, this doesn't really matter. Whether you pay the bill in June or July may not make any difference. But this really comes up at the end of the year, particularly if you're on a calendar year basis, where in December, you actually have a bunch of money that comes in because people are hopefully making their December gifts. But if they're writing checks, and frankly, with your populations, I bet you a lot of people do still write checks. They may mail the check to you. The check is dated December 25th, but you don't get it until January 15th. If you're using cash accounting, that money counts to the new fiscal year. If you were using accrual accounting, you would add all of that up and do an entry that would count the money to the prior fiscal year, the year in which the check was dated. And sometimes this can be significant. If you have big year-end campaigns, this can be significant. There is no, what am I trying to say here? Cash accounting is fine. There's no problem with cash accounting. Accrual accounting, however, does give you a little bit better picture of where you are as of a particular date and time. So on your balance sheet, you have your total assets here, mostly cash, but in this case, a big receivable. And you have all of your liabilities here. What do you owe other people? You owe your credit card, you owe a few payroll liabilities, etc. And you end up with your net and so the difference between you take your assets and you subtract your liabilities and you get what QuickBooks calls equity, which is again, nonprofit speak, net assets. In this case, this organization had $293,000 of carryover surpluses from all prior years of its existence. So it has this nice reserve of net assets. And then for the current year, it's showing $6,000 in net income, which gives it total net assets of just under $300,000. Again, this is as of May 31st, as of June 2nd, it could be a very different picture. But this is very important to know the difference between the balance sheet, point in time, and the statement of activity or the profit and loss statement, which is activity over time. And then I've already talked about this detailed report that you can get, which again, I live by this report. It really is helpful.
And one question in here, which method of accounting is required for 1099s?
Okay, good question. A 1099 is the equivalent of a W-2, but for a contractor. So if you pay your accountant, who is an independent contractor, not an employee, $500 over the course of the year, you need to send a 1099 to that person and to the IRS saying that you paid that person. Well, actually, $500. You don't have to send a 1099 unless it's $600 or more. So let's say you paid your accountant $750. So you're going to send a 1099 to your accountant. You have to do that no matter what kind of accounting system you use, whether you're cash-based or accrual-based. 1099s are based on when you made the payment. So to that extent, a 1099 itself is cash-based in the sense that if you paid them twice during the year of, 400 plus 350, then you would send them $750. So it's when the cash went out is how you determine the amount on the 1099. Somebody's going to ask which, if anything, is required for 990s. Both are appropriate for 990s. You can use either one. It is more, you will give people a better picture of your situation if you're using accrual accounting. But again, for small organizations, a cash accounting can be absolutely fine in terms of what you're telling your donors through the 990. Again, last time I had a couple of questions about the roles of various people. For example, what's the difference between the role of the accountant or bookkeeper and the treasurer? And Kim, these useful resources that are at the bottom of that page, this is the time to put them in the chat. If you are fortunate enough to have two separate people doing the work of keeping your financial records. So if you had a bookkeeper, basically the bookkeeper or the accountant would be the day-to-day maintenance of the accounting records, preparing the reports and assistance with the budget would be the day-to-day stuff to make sure you can operate. The treasurer, on the other hand, is the supervisor of the accountant and the enforcer of internal controls. And let me say a word about internal controls. If you were to go to the General Accepted Accounting Principles, GAAP or GAAP, they go on and on about internal controls, and internal controls are important. You need your donors, your members, you want to make sure that everything is above board and there's no fraud or hanky-panky going on with your books. And the best way to protect that is to have strong internal controls. What GAAP would tell you is you should have one person doing payroll and a separate person doing payables and a separate person doing receivables and blah, blah, blah. You don't have that. So what you would have is your treasurer who would basically then check what the accountant or bookkeeper is doing. And they do this in a couple of different ways, and you can see what works best for you. But in terms of approving the payment of invoices, let's take that as an example. You could have a financial policy that says your executive director is authorized to approve all expenses up to, make up a number, $3,000 without getting a second approval. But anything beyond that needs to be approved by the treasurer. So you would have two people signing off on the expense so that it's quite clear that he or she is not buying stuff that they shouldn't be buying. The other example of this is that the treasurer would look at a list of the checks or the payments, I should say, nobody writes checks anymore, a list of the payments that are made each month to make sure that they're not going to a strange vendor. My husband runs a big think tank here in town. They were scammed out of $150,000 because their tech person kept submitting invoices to the appropriate approver that were being paid to a fake company, and the money was going into his personal account. Now, that's clearly a failure of internal controls, because the approver should have said, I don't know who this company is, what's going on, let me see what's going on, so that we can fix this out. So it can happen. It certainly happens in big organizations, and it can definitely happen in small organizations. But the easiest way to do that is to have the treasurer look at a list of, who's getting money and from what. Hopefully in the chat, which I don't have open here, there are links to 2 resources, one of which is a QuickBooks Online accounting introduction to nonprofit accounting, which is pretty good. And the second is called Treasurers of All Volunteer Organizations, 8 Key Responsibilities. This is a really good brief description of the kinds of things that should be set up so that there are internal controls in your organization. It's put out by an online publication called Blue Avocado. You can subscribe to Blue Avocado for free, and I recommend that you do it because it has some good articles and some good discussions about trying to manage nonprofit organizations, both large and small.
Thank you, Juliet. Kim put both of those links in the chat. I'm going to add the Blue Avocado link. And then Julie, Julie generously offered to put her email address in the chat for people that wanted to contact her with follow-up questions.
Absolutely. I would be happy to chat with anybody, email or phone. If you have specific questions about how to deal with some unique problem that you have, or some issue that you have that you want to talk longer about.
Great, I've done that. And there was a little bit of discussion in the chat, people having some tips for places to access QuickBooks. But does anybody have other questions? If you want to unmute or put it in the chat.
Julie, on the statement of financial position, one of the things we do in the long-term assets section is separately account for, an estimated 12 months of operating expense. And that's 12 months because our board set it at 12. Initially, it was 4 months, and then 6 months, and then more recently 12 months. But it's a way to take that, what for some may be a nice amount of money, and let funders and others know that there's actually a reason why it's sitting there in long-term assets.
Yeah, no, that's a good point. I mean, that line on my sample chart of accounts that says unrestricted net assets. Again, those are your reserves. Those are your, rainy day funds, whatever you want to call them. And your board is entitled to split that up into several pots of money if they want to. They might, for example, put aside $5,000 to be spent at some future time on equipment. Or as Wendy has suggested, this is our 12-month expenses over the last few years have averaged this. So we're going to set aside X number of dollars to have it as as a lack of a better term, a rainy day fund. The other thing that will happen here, if you're small organizations, you may not have this problem, but as you get larger, or even if you are, let's presume somebody unfortunately dies, but fortunately leaves you a bequest. So somebody says, I'm leaving $10,000 to my favorite village, and I want them to use it for X. That creates yet another sort of level of accounting that you need to be very careful about. You need to separate that money in this section on your balance sheet because it is a donor restricted amount. You don't have any choice about how to spend it. If you didn't want to spend it on what they wanted, you should have not accepted the money in the first place. But if it is a restriction by the donor, you are legally obligated to spend it on whatever it is that they say to spend it. Now, again, if all they say is, I think I want to spend $10,000 on yoga classes, then you just, every year, as you spend your, as you pay for your yoga instructor, you will reduce the amount that is available in that fund as you spend it down. But it is important that you track those donor restricted gifts very carefully. Now, I personally, again, I hate donor restricted gifts. That's not fair. I like donor restricted gifts, but what I really like are unrestricted gifts. So my advice to you is don't go out and run 3 different campaigns for something very specific, unless you really do have something like you want to buy, I don't know, you want to buy a car for the organization to use, fine, you can have a campaign that is for the car, but you would have that in and out of your books in a year. I would really encourage you to encourage unrestricted donations as much as you can. I fully understand that there are many times when raising money for a specific purpose can be very effective. So I'm not telling you not to do it. I'm just telling you to be careful about it. And when you do it, make sure that you are tracking that income and that you are tracking the expenses that can be applied against that income.
Julie, along those lines, we have a restricted account for financial aid. So we raise money separately to support our membership cost for lower income seniors who join our village. So as you mentioned, it's a very effective fundraising tool. People like to donate to that. We have had that restricted financial aid fund since we started. It was initially seeded with $5,000 from an anonymous donor, and we continue to this day to have a very vibrant financial aid fund, which is helping us immensely.
Right.
We also have restricted accounts for some of our grants that come in with a time or purpose restriction. So we just, again, it's an accounting.
Oh, right. That's a good point too. Yeah.
There's
right.
a couple. Go ahead.
Just because somebody could give you a gift that says, here's $10,000, $5,000 can be spent next year, $5,000 can be spent the year after that. So again, you have to make sure that you're tracking that as well. There are ways to track that in QuickBooks. I'm not going to get into it here because it can get complicated. Sometimes a separate spreadsheet is just the easiest way to do it, to make sure that you're being true to the donor's intent.
So there's a few questions in the chat, not necessarily related to what you've got on the screen. So we could probably end that screen sharing. One person recommended a great book, Nonprofit Accounting for Volunteers, Treasurers, and Bookkeepers by Lisa London. And then there's a couple questions. How does fund accounting apply to nonprofits? And also, what is the hourly rate for a contract bookkeeper for villages that don't have a qualified volunteer to fill this role?
I'm sorry, the first half of the question was?
The first half was, how does fund accounting apply to nonprofits?
Fund accounting is basically what we were just talking about, where you have, it's just another way of keeping your records. So that you would have, these expenses can come out of the general fund, these expenses come out of the Hamry bequest fund, these expenses come out of the flower fund, whatever the case may be. So it is not generally, well, how can I say this in a polite way? Our friends at GAP have decided that they don't really like fund accounting, but lots of organizations still use it. And again, it's primarily a way of tracking restricted income and restricted expenses. I can't tell you what it costs to hire somebody. You'll be appalled. It drives me crazy. There should be more people like me who do this for the, I don't want to say for the love of accounting, but for the love of working with small nonprofits.
But can I just say something?
Yeah.
I think you can just Google, like, what does a nonprofit accountant make in my area to come up with a rate, and it's probably not as high as somebody who's a CPA.
Right, and that's a very good point. I am not a CPA, so obviously that limits whatever I might be able to charge. and you don't need a CPA. I mean, there can be advantages to that, but you don't need it. I tell you, there is a huge hullabaloo going on now in the nonprofit world about the cost of audits. I don't know how many of you actually have audits done. Hopefully not many of you, because they are wildly expensive and only getting worse. Young people these days do not want to become accountants, and the accounting firms are desperate for, you know, for people. And of course, the fewer people they have, the more their rates go up, et cetera. So
Julie, we got a crazy number of $20,000 to do an audit. And that
For
was, I think,
Wave?
the lower. It could have been
Oh,
20 to
no,
25
for your village, not for Wave.
for the village, right?
Right.
For an
20
audit, and not a financial statement review, not the 990, but for an audit itself. I know
20
that Diane has her name up and hand up, and she's probably waiting.
I have been, Wendy, thank you, but there's questions are so good. I have two questions. One is to ask Julie if you clarify or expand a little bit on how one can account and keep track of what one is spending against a grant that has, you know, where we've said we're going to do X, Y, and Z things with this money that we're applying for. We get a grant, and how, you know, how do we track how we're doing that? That's one question. And the other question is very different, and that's, we got started as a village a number of years ago, doing a budget, not really very much ahead of time, but actually at the beginning of the year. In actual practice, our year's budget starts we get it finished in February or March. Now that doesn't strike me as being a very good arrangement, but what would you suggest we do?
Well, that's a great, let me do the second one first. I love that. Budgets are aspirational and can change. The fact that you don't have one until March, no, that's not great practice. If you were to actually have an audit, the auditor would probably write in his management letter, here are the things you could do better. And that would certainly be one of them, is to get but you know, to me, that's not the end of the world, especially for smaller organizations. As long as you're planning ahead and have something, you know, it's hard if you're a calendar year, organization, because chances are you're doing budgeting during November and December, and, you know, lots of things are going on in people's lives during November and December, and it's, you know, hard to get people together. So I wouldn't be losing sleep over that one for sure. In terms of accounting for your grants, the way that QuickBooks and I would suggest that you do this is, in QuickBooks, you are allowed to set up what are called customers. Again, this is one of the things that drives me crazy about QuickBooks. Even in their nonprofit version, they use the wrong terminology, but a customer is the same thing as a donor. If you run a flower shop and you have a customer, that's somebody who gives you money. If you run a nonprofit and you have somebody who gives you money, that's a donor. So a customer and a donor are exactly the same thing, concept-wise. You can in QuickBooks a customer, and you can, when you enter the amount of the grant that you receive, you tie that amount to a customer. And again, there's a way to do it in QuickBooks. Then for each expense that you apply against that grant, you tie that expense to the customer. And then you can run a report showing the activity for that customer.
That's clear. Thank you.
Yeah, Jill?
There's a setting, at least in the online version, I'm not sure about the desktop version. You can change the name of customers.
Oh, yes, that's true.
First.
Yeah, that's true. You can. But the concept is important to know. Customers or donors are people that give you money. Vendors are people that you give money to. So one is coming out and one is coming in.
You know, Diane, one of the things I do with our grants is generally the grant we're getting doesn't pay for the full cost of the project. So I really think about what expenses I'm going to tie to the grant. And oftentimes I'll use salary expenses because I know that I have timesheets, and that provides great documentation without having to capture a lot of, you know, little bit of invoices and small payments that we make. So it's just another thing to think about when you're developing a grant budget.
Yes, we actually have been doing that pretty well. You know, we associate a certain amount of our administrative person's time with a given proposed grant activity. Naturally,
Mhm.
it's not clean and neat, but it is what we do that helps with that problem, Wendy.
Mhm.
Thing you have to be careful about with grants is you have to be careful not to charge the same expense to multiple grants.
Mhm.
And particularly with salaries, that can be tricky. And sometimes, like I say, it's easier to do it outside the system on a spreadsheet. So you know, if you have somebody who makes, you know, $100 a week, and you're charging 20% of that to grant A and 50% of that to grant B and the rest to, you know, general overhead, you know, there are ways to record that in QuickBooks through journal entries. But again, you know, you just need to be careful not to double dip. This was a huge challenge during COVID when everybody was getting all those government grants from COVID, and you would get a paycheck protection grant and you would get something else. You know, I mean, it could get very tricky, but hopefully for smaller organizations, you're only having to worry about a couple of grants that you're working with.
This is great. We've gone over a few minutes. Julie also generously offered to stay on for those who wanted to, or officially ending. And Kim, we could end the recording, but if people would like to stay on and ask more questions,
Did you
feel
put
free
my
to unmute.
email? Did you put my email in the chat?
I did.